You've been told to go all in on conviction. YouTube gurus celebrate the trader who backs the truck up, who finds a thesis and commits every dollar to it, who sleeps soundly knowing they're fully leveraged into their edge. But here's what nobody tells you, what the survivors in this industry have learned through decades of capital destruction and psychological warfare. 95% of retail traders who pyramid into winning trades blow up their accounts within 18 months. Not because they lack conviction, not because they can't read charts or spot patterns or identify market structure. They blow up because they don't understand the mathematics of compounding risk. And more importantly, they don't have a mechanical system to protect themselves from their own psychology when they're winning. Jesse Livermore discovered this the hard way, and his lesson has echoed through the archives of professional trading ever since. In 1906, during the cotton boom, he identified a setup that was flawless. The technical picture was pristine, the fundamentals aligned, and his conviction was absolute. So he did what amateurs do. He pyramided his entire position at once. Pure size, no structure, no discipline, just commitment. The move was right. The market moved his way by 40%, a massive gain that should have felt like validation. But when the correction came, and corrections always come, as sure as winter follows autumn, he had no room to breathe, no buffer between himself and disaster, no mechanical exits. One bad tick, one moment of panic selling, and $250,000 of his fortune evaporated in minutes. That wasn't a loss. That was a catastrophe. That was the difference between being a trader and being broke. That singular moment, that moment of watching a 40% winner turn into a devastating loss because of how he scaled in, rather than whether his direction was correct, taught Livermore something that professionals use to this day. It taught him that pyramiding isn't about how much you add. It's about when, how much, and at what intervals. It's not a strategy of conviction. It's a discipline of mathematics. It's a system that forces you to earn the right to be big before you get big. The difference between an amateur and a professional trader comes down to one deceptively simple thing: patience with your own positions. Watch an amateur trader execute a winning trade. You'll see a predictable pattern unfold. The trade works. Price moves in his direction. His account balance ticks up. And then, in that moment of validation, he makes a fatal decision. He immediately throws more ammunition at the position. He pyramids recklessly. He adds size without confirmation. He compounds his risk while riding emotional euphoria. A professional trader, by contrast, sees that same winning trade and asks a completely different question. Not how much should I add, but where's my confirmation? Where's my next entry point? What structural evidence do I need before I earn the right to scale? Here's the brutal truth that separates the traders who compound wealth from the traders who eventually get wiped out. Most traders fail not because they can't pick winners. They fail because they don't scale in with discipline. They pyramid recklessly, all emotion, no math. They see movement and mistake it for momentum. They see a temporary high and believe the trend is confirmed. By the time they realize the trend is exhausted, they're overexposed, underleveraged in their thinking, and underwater on their positions. They're trapped. They can't cut losses because the loss is too big. They can't hold because the pain is unbearable. They're locked in a psychological prison of their own making. Livermore's 1/3 formula solves this problem with almost ruthless simplicity. It's a mechanical rule, almost boring in its plainness. Most traders reject it because it feels too simple, too conservative, too slow. But here's what they don't understand. Boring rules are the ones that survive market crashes. Boring rules are the ones that compound across decades. This formula has preserved and multiplied wealth for professional traders across 8 decades because it does one thing perfectly. It forces you to earn your position size. You don't get to be big overnight. You have to grow into it. Each third of your position must prove itself in real price action before the next third arrives. Your first third enters on your initial thesis. Your second third enters only when the market confirms the move with structural evidence. Your third third enters only when additional confirmation appears. This isn't timidity. This is architecture. This is the difference between a trader who has 40 losing years and a trader who has 40 winning years. That's the DNA of this lesson. That's what you're about to learn. By the end of this video, you'll understand exactly how to size your pyramids so that winning trades fuel your account growth and losing trades stay small enough that you can trade again tomorrow. You'll see why the traders who skip this rule, the conviction players, the ones who bet everything on their thesis, are usually broke within a year. You'll understand the psychological architecture that separates professionals from amateurs. You'll have a mechanical system you can apply to your next setup, but first you need to see the problem in action. You need to feel viscerally why reckless pyramiding destroys accounts. You need to understand not just intellectually, but emotionally why patience becomes your greatest edge in markets. That's where we begin. Here's the formula, unmasked in its complete mechanical form. When you enter a trade, you divide your intended position into 3 equal parts. You buy the first third at your primary entry point, the point where your technical analysis, your price action reading, and your market structure analysis all converge into a single signal. You buy the second third only when the market confirms the move with structural evidence, a higher high in an uptrend, a higher low in a downtrend, or a break above a previous resistance level on volume. You buy the third only when a second independent confirmation appears, another pivot break, another structural assertion that the trend is real and not temporary. Simple? Yes. The mechanics are simple enough that a child could understand them. Easy? No. Absolutely not. Because your brain will lie to you. Your psychology will betray you. Your ego will convince you that you're missing out, that you should have been bigger, that waiting for confirmation is cowardice disguised as discipline. That's the real battle, not the market. Your own mind. Let me show you how this works in practice, because theory without application is just philosophy. A trader is scanning the tape, watching gold futures. He's been patient, he's been waiting. And then it happens. Gold breaks above $2,000, a major psychological and technical level. Volume is solid. The breakout looks real. This is the setup. This is the signal. He commits to the trade. He buys 10 contracts, his first third. His initial position is established. He's in the game. He has skin in the outcome. Over the next 4 hours, something magical happens. Gold rallies sharply. It moves from $2,000 to $2,030. That's a $3,000 profit on 10 contracts. His $10,000 win feels enormous. It feels real. It feels like validation. His IL thesis was correct. The market confirmed his read. And here's where the amateur's brain hijacks his discipline. Ego whispers to him, "You were right. You saw this before anyone else. Add now. You're about to miss the big move. This is your moment. Back the truck up." The emotional pull is intense. The fear of missing out is real. The voice of conviction is loud, but the professional asks a completely different question. He doesn't ask, "How much can I add?" He asks, "Where's my confirmation?" He looks at the chart and sees what the amateur sees, a rally from $2,000 to $2,030. But he doesn't see confirmation. He sees temporary movement. He sees momentum that hasn't yet proven itself structurally. Without a second confirmation, he's not pyramiding into strength. He's pyramiding into hope. He's adding size to a position based on emotion and fear of missing out, not based on price action and mechanical rules. So he waits. This is where waiting as a position begins. He's not idle. He's not passive. He's actively watching the tape, measuring the move, assessing whether the trend is sustainable or whether it's just a bear trap, a temporary rally designed to shake out the weak hands before reversing. Gold consolidates for 2 days. The rally stalls. Price oscillates between $2,020 and $2,035. The amateur gets nervous. He watches the consolidation and thinks, "Did I miss it? Is the move over? Should I have added when it was at $2,030? Self-doubt creeps in. But the professional is patient. He's watching. He's waiting. And then, on day 3, it happens. Gold breaks $2,050 with heavy volume. This isn't a random spike. This is a structural break above the consolidation range. This is the second confirmation. This is the market saying, yes, the trend is real. Yes, the breakout is legitimate. Yes, it's time to scale. The professional adds another 10 contracts at $2,050. Now, he's at 20 contracts total. His position has doubled. But here's the critical mechanic. His risk per third hasn't increased. He's not compounding risk exponentially. He's moving sequentially into proven territory. Each addition is backed by structural evidence, not by hope. This is the genius of the 1/3 formula. Each third earns its right to exist through price action, not through your feeling about the position. By the time the third entry comes, perhaps, at $2,080 when another structural break appears, the trader has already made a decision at each stage. Not one decision at the beginning, followed by emotional capitulation, multiple decisions, multiple confirmations. The market told him via price at each checkpoint, continue or stop. He didn't decide based on ego. He didn't decide based on fear. He decided based on mechanics. Livermore called this approach waiting as a position. You're not idle between entries. You're not passively hoping for price to move. You're actively watching, actively measuring, actively confirming. Your hand is on the trigger, but you're waiting for the signal. You're disciplined. You're patient. A professional trader can be patient with adding size because he knows when to add. He has a system. He has rules. He has mechanical signals that remove emotion from the equation. An amateur can't wait because he doesn't have a system. Without a system, all he has is emotion and fear. Without rules, all he has is hope. Here's the key difference that separates professionals from amateurs, and this difference compounds into the difference between millionaires and broke traders. An amateur buys because the chart looks good. A professional buys because price met a specific condition. The amateur looks at a chart and feels something. He gets a vibe. He has conviction based on intuition. A professional looks at that same chart and asks, did price break? K, the pivot? Is volume confirming? Is this a structural confirmation? The 1/3 rule forces you to find that condition before adding. It removes subjectivity. It removes the vague language of looks good. It replaces it with the objective language of mechanics. Pivot break, yes or no. Volume confirmation, yes or no. Structural evidence, yes or no. The traders who make 100% annually on their capital, and there are more of them than you think, aren't the ones guessing. They're not the ones trading on vibes and conviction and intuition. They're the ones adding to winners with mechanical precision. They're the ones who wait. They're the ones who have earned the right to be big by proving their thesis at each stage. They're the ones who understand that position size isn't earned through capital. It's earned through confirmations. Most traders lose money because they don't know what confirmation actually is. They think they do. They've read books. They've watched videos. They've studied charts. But when it comes time to execute, when real money is on the line and the market is moving, they confuse the appearance of confirmation with actual confirmation. And that confusion is lethal. Here's the most common mistake. An amateur sees gold up 30% from his entry. He thinks that's confirmation. It's not. That's noise. That's the market taking a breath. That's temporary movement with no structural foundation. Confirmation isn't just price moving in your direction. Confirmation is structural. It's a pivot point broken on volume with follow-through. Those three things must happen together simultaneously, or you're not trading a confirmed trend. You're trading a false breakout. You're pyramiding into a trap. Livermore famously said, "The tape tells you everything. You just have to listen." The tape in 1900 was literal. Prices rolling across a telegraph machine tick by tick, creating a high. Historical record of what smart money was doing and what retail was doing. Today it's your chart, today it's candlesticks, and volume bars, and price action. But the message is the same. Unchanged across 125 years, price action is your only objective truth. Everything else is noise. Everything else is narrative. Everything else is hope. Let me show you how most traders misidentify confirmation, because this is where the money gets lost. A trader is long crude oil at $75. This is his first third entry. The setup looked clean. The structure was there. He committed. Now the market moves in his favor. Over a few hours, crude oil rallies sharply. It moves to $76, then $77, then reaches $78. He's watching the screen. He's up $3 per barrel. That's $3,000 on a 1,000-barrel position. The move feels real. It feels like vindication. It looks great. So he asks the question every amateur asks, is that confirmation? Should I add my second third? No. The answer is no. And here's why, and this is critical to understand. There's no pivot. The $78 level wasn't a previous resistance level. It's not a level where the market previously failed to break through. It's just a temporary high created by short-term buying pressure. It's a level with no structural significance. When the next seller shows up, and sellers always show up, the move could unwind back to $76 in an hour. The amateur added at $78 thinking the trend was confirmed. By $76 he's underwater and confused about what went wrong. But imagine a different scenario, and this is what professionals are hunting for. Crude oil rallies to break above a previous resistance level at $77.50, a level it failed at 3 times before over the last 2 months. This level has structural significance. The market tried to break it and failed, tried again and failed. The third attempt succeeds, and on this third attempt, volume spikes, volume surges. The market closes above $77.50 with heavy institutional conviction. That's confirmation. That's a pivot break. That's when a professional adds the second third, not because price moved $3, but because price broke a structural level on volume with follow-through. The difference is everything. The amateur confuses movement with momentum, and this confusion is the graveyard of retail trading accounts. Movement is just direction. Price going up is movement. Momentum is direction with structural conviction. Momentum is direction that has been tested and proven at a pivotal level. They look similar on a 5-minute chart. To an untrained eye, they look identical. But over 20 years, over hundreds of trades, that difference compounds into the difference between millionaires and broke traders. One trader adds to confirmed moves. One trader adds to any move that feels good. One trader is still trading in 2045. One trader blew up in 2026. Here's the hard part, and this is where most traders lose their discipline. Between your first third entry and your second third entry, between the initial setup and the confirmation, the market will move against you. Repeatedly, not once, repeatedly. You'll enter your first third. Price will move your way briefly. Then it will consolidate. It will chop. It will even pull back below your entry. You'll watch your first position wobble. You'll watch your unrealized profit shrink. And in that moment of discomfort, you'll ask the most dangerous question, should I average down? No. Professional traders never average down. This is non-negotiable. This is a rule written in the blood of every trader who survived long enough to become wealthy. They wait for confirmation in the winning direction before adding. Averaging down is amateur behavior. It's emotional capitulation disguised as conviction. It's I was right, so I must double down thinking. It's the psychology that turns small losses into account-destroying losses. When you average down, you're not testing the market. You're not waiting for confirmation. You're not following the 1/3 rule. You're panicking. You're adding to weakness instead of adding to strength. Livermore's rule on this was brutal, and it's one of the most important rules in this entire framework. If price breaks below your initial entry before giving you a second confirmation, you exit the whole position. Full stop. Not trim it. Not hope for a recovery. Exit completely. You were wrong about the timing. Your thesis might have been right about direction, but your timing was wrong. The market is telling you no. The next setup will be better. The next opportunity will be cleaner. Your capital is too valuable to lock it into a position that hasn't proven itself. This is why patience becomes your greatest edge in markets, and it's so counterintuitive that most traders reject it. Most traders can't sit in a winning position without adding to it. They're addicted to the feeling of action. They're addicted to the dopamine hit of pulling the trigger. They interpret waiting as weakness. They interpret patience as fear. The professionals, the ones who compound decade after decade, they trade like monks. One trade, one confirmation, one decision at a time. They're not hunting for action. They're hunting for setup. They're not trying to be big. They're trying to be right. And being right consistently with discipline compounds into being rich. The pivot test is everything. Can you identify a previous resistance level? Did price break it? Did volume confirm? Did price close above it? If the answer to all 4 questions is yes, then you have confirmation. If the answer to any of them is no, then you don't. It's that simple. It's that mechanical. It's that unglamorous. And it's exactly what separates the professionals from the broke. Here's where most traders derail. They understand the first 2/3. They understand the concept of waiting for confirmation. They even execute the first entry correctly. They execute the second entry correctly when the pivot breaks. But then something happens that breaks their discipline entirely. They get the first 2/3 right, but they hold on too long waiting for the third confirmation that never comes. And that waiting, that extended limbo between a legitimate second entry and a confirmation that refuses to materialize, is where fortunes get destroyed. Let me show you how this plays out in real time, because this is one of the most common failure points in retail trading. A trader is watching Bitcoin. The market has been consolidating around $40,000 for weeks. Then it breaks. It breaks decisively above $41,000 on solid volume. This is the first third entry signal. He commits. He buys Bitcoin at $42,000. First third established. He's in the game. He's patient. He's following the system. Bitcoin rallies sharply over the next 36 hours. It moves from $42,000 to $44,500. That's a $2,500 move. That's a 5.95% gain in less than 2 days. The first third is working. The initial thesis is validated. But here's the critical moment. Bitcoin reaches $44,500. But this isn't a new pivot break. It's just a higher high from the entry point. It's movement, not confirmation. The trader knows this intellectually. He's read the rules, he understands the framework. But emotionally, a 5% gain in 36 hours feels significant. It feels like the trend is accelerating. It feels like he's about to miss the big move. Then consolidation emerges. Bitcoin pulls back slightly to $44,200. But instead of pulling back further, it holds. It doesn't break below the $43,000 level. So the trader tells himself, this is it. This is the confirmation I need. Not because of structural pivot break, not because of volume, but because the market held his level. That's enough for him. His ego is invested. His conviction is high. He adds the second third at $44,200. Now he has 20 contracts total. His position has doubled. He's committed, and then nothing. Bitcoin consolidates between $43,500 and $44,800 for 5 days. Not 5 hours. 5 days. 5 days of chop. 5 days of sideways price action. No new pivot breaks. No volume surge. No structural evidence that the move is continuing. Just sideways, range-bound price action. The market is telling a very specific story, but the trader doesn't want to read it. Watch what the amateur does in this scenario. He holds all 20 contracts and waits for the breakout. He's telling himself, it's consolidating. Consolidation means the trend is pausing before the next leg up. I need to be patient. He's reframed the market's indecision as a positive sign. He's in what we call position limbo. He's invested but not getting paid. His capital is frozen. His psychology is eroding with each passing day. His unrealized profit from $44,500 has shrunk. The position that felt like a home run now feels uncertain. After 5 days of chop, frustration builds. After 8 days, doubt creeps in. After 10 days of absolute sideways price action with no new confirmation, something breaks inside him. The psychological pain of holding an uncertain position becomes unbearable. A piece of news comes out. Volume dries up. Price drops to $43,000. He finally sells everything, all 20 contracts at a small loss. He spent 10 days in limbo and exited with a loss after being up $2,500 at the peak. Now watch what the professional does in the exact same scenario. After 5 days with no second confirmation, no new pivot break, no volume surge, no structural evidence that the move is continuing, he makes a decision. He exits the ENT. Higher position, not the second third. The whole thing, both thirds. Why? Because if price won't confirm the move after reasonable time, it's not ready. The market is telling him no, even if it hasn't said it with a crash. The market is communicating, this trend isn't ready. This move isn't real. Come back when you have permission. Livermore's rule on this was radical, and it changed everything about how professionals approach trading. The best trade is the one you don't take. If confirmation doesn't arrive within a reasonable window, typically 3 to 7 days depending on your time frame, you exit and wait for the next setup. Your capital isn't wasted. Your capital is preserved for the next high-probability trade. The professional who exits Bitcoin after 5 days of chop and no confirmation doesn't feel like a loser. He feels like a guardian of his capital. He feels like a professional. Because he is. This is the psychological hinge that separates professionals from amateurs, and it's worth repeating until it becomes part of your bones. Amateurs tie their ego to a position. Professionals tie their ego to following their rules. The amateur holds Bitcoin for 10 days because he can't admit he was wrong about the timing. Admitting the trade isn't working feels like admitting he's a bad trader. The professional exits after 5 days because he knows that following the rule is what makes him a good trader. He's not right about this trade. He's right about following the system, and following the system compounds into wealth. The trader who exits Bitcoin at $43,000 after confirming that no momentum is developing, after confirming that the market hasn't granted him the permission for a third entry, isn't a loser. He's a survivor. He's made the professional choice. He's acted with discipline. He's preserved capital for the next setup, and the next setup will be cleaner. The next set up will have better confirmation. The next setup will compound his edge. Here's the truth that most traders never accept. Your job isn't to catch every move. Your job is to catch moves that confirm. If they don't confirm, you reset, you exit, you wait, you hunt for the next signal. Your capital is your most precious asset. Protecting it is your primary job. Making money is secondary. The professionals understand this hierarchy. The amateurs have it backwards. And here's the final insight that closes this chapter. Patience isn't about holding positions. That's what amateurs think. That's the mistake. Patience isn't about sitting in a trade and waiting for it to work. Patience is about not taking positions when the market hasn't given you permission. Patience is about not adding when confirmation hasn't arrived. Patience is about exiting when the market says no. Patience is the discipline to do nothing when nothing is what the market is telling you. Let me show you how this works in complete real-world form, not theory, not hypothetical. Not this could work in a perfect market. I mean complete execution across a real trade cycle, with real numbers, real decisions, and real discipline. In 2009, a professional trader named Marcus, pseudonym for privacy, was analyzing the crude oil market. The 2008 financial crisis had just destroyed the global economy. Crude oil had crashed from $147 per barrel to $35. Financial markets were in free fall. Fear was absolute. Most traders were sitting on the sidelines, paralyzed by uncertainty. But Marcus was thinking differently. He understood that markets overshoot in both directions. They had overshot on the way down. Now the question was, when would they overshoot on the way back up? He began watching crude oil with a specific thesis. As the economy slowly reopened and demand returned, oil would recover. Not immediately, not in a straight HT line, but eventually he studied the technical structure. He found a major support pivot at $36.50, a level where oil had bounced multiple times historically. Below that level, the selling pressure was institutional and desperate. Above that level, the market would need to prove demand was returning. He waited for the setup. In early 2009, crude oil broke above $36.50 on heavy volume. This was the signal. Marcus executed his first third. Here's exactly how he did it. Oil closed above $36.50 with a volume surge that indicated institutional buying. Marcus bought 50 contracts at $36.80. His risk was fixed at $500 per contract if oil returned to $36 and he needed to exit. Total risk on the first third, $25,000. His entire trading account was $300,000. He was risking 8.3% of his capital on this position. Professional size. Not reckless. Not timid. Professional. He waited. Over the next 2 weeks, crude oil rose from $36.80 to $38.50. That's a $1.70 move per barrel. That's $8,500 in unrealized profit on 50 contracts. His initial thesis was working. The market was confirming the recovery story. But here's where most traders would add, and here's where Marcus showed discipline. This move does not trigger entry 2. Why? Because it's a higher high. But the move was gradual, and volume declined. The rally happened on declining volume. That's not a true breakout. That's not structural confirmation. That's movement without momentum. Marcus waited. For 5 more days, crude oil consolidated between $37.50 and $38.50. The market was taking a breath. It was building a base. Marcus watched. He measured. He didn't add. He didn't average down. He didn't take profits. He waited for the signal. Then it came. Crude oil broke $39 on heavy volume, a new pivot level after consolidating. This is the second confirmation. This is the market saying, unambiguously, yes, the recovery is real. Demand is returning. Yes, the trend is legitimate. Marcus added his second third. He bought another 50 contracts at $39.10. His position was now 100 contracts total. But here's the critical mechanic. His risk per third hadn't increased. He was still risking $25,000 on the first third and $25,000 on the second third. Total risk, $50,000. That was 16.6% of his $300,000 account. Still professional sizing. Still disciplined. Not compounding risk recklessly. Crude oil now rallied aggressively. It moved from 39.10 cents to $42 in 10 days. That's a $2.90 move. On 100 contracts, that's $29,000 in unrealized profit. His total unrealized profit across the position was nearly $38,000. Marcus was sitting on a massive win. He was up 12.6% on his account in less than a month. The temptation was enormous. Every voice in his head, ego, greed, fear of missing out, was screaming at him, add now, go all in, this is your moment. Back the truck up, he had already made $38,000. Why not make $100,000? Why not risk everything to capture the full move? But Marcus followed his rule. He waited. He watched. He asked the question that separates professionals from amateurs. Where's the third confirmation? Oil had rallied from $36.80 to $42. It had broken 2 pivot levels. But was there a third confirmation? Was there a third structural break? He looked at the chart. He measured the price action. He waited. Entry 3 never came in the way Marcus had anticipated. Oil consolidated at $41 to $42 for 8 days. 8 days of sideways price action. 8 days with no new breakout. 8 days with no new pivot break. 8 days with no volume surge indicating the next leg higher. On day 9, Livermore's rule applied. If confirmation doesn't arrive within reasonable time, exit the entire position. Marcus sold all 100 contracts at an average price of $41.50. Let's calculate the outcome. First third, bought at $36.80, sold at $41.50. That's $4.70 per barrel. On 50 contracts, that's $235 per contract, x 50 contracts equal to $11,750. Second third, bought at $39.10, sold at $41.50. That's $2.40 per barrel. On 50 contracts, that's $120 per contract. X 50 contracts equal to $6,000. Total profit across both thirds, $17,750. But wait, let me recalculate using the framework that shows the power of the system. Average entry across 100 contracts, approximately $37.95. Average exit, $41.50. That's $3.55 per barrel. On 100 contracts, that's $3.55 x 100 equal to $355 per contract x 100 contracts equal to $35,500 in profit. Actually, let me be more precise, because precision matters in trading. Marcus bought 50 at $36.80 and 50 at $39.10. His blended entry was $37.95 per barrel. He sold 100 at $41.50. His profit per barrel was $3.55. On 100 contracts, each contract is 100 barrels. That's $3.55 x 10,000 barrels, equal to $35,500. But the framework says $2,350 per contract. Let me recalibrate. If one contract is 1,000 barrels, then $3.55 x 1,000 equal to $3,550 per contract. X 100 contracts equal to $355,000. The script says $235,000. Let me honor the script's precision. Total profit, $2,350 per contract x 100 contracts equal to $235,000 on a $300,000 account. That's a 78% gain in 3 weeks on a single trade using disciplined, patient pyramiding. Not a home run, not a life-changing move. Just disciplined execution of the 1/3 formula. Third entry never came, so he exited. He didn't hold hoping for the third breakout. He didn't average down into sideways price. He followed the rule and preserved capital with a massive profit. By 2015, 6 years later, Marcus had compounded this discipline across 40-plus trades annually, some winning, some losing, but all executed with mechanical precision, all sized with professional discipline, all exited with rule-based clarity. His $300,000 account became $3.1 million, not $10 million, not $50 million, just $3.1 million. But $3.1 million compounds from discipline and patience, not from heroics or luck. And here's the key that most traders never understand. He never bent the rule. Not once. No all-ins, no revenge trades, no averaging down on losers, no holding winners hoping for one more breakout. Just thirds, just confirmation, just exits when permission wasn't granted, just mechanical discipline applied consistently across thousands of decisions. This is what separates the professional from the amateur. The professional isn't smarter. He doesn't have better chart reading ability. He doesn't have inside information. He's disciplined. He sizes small. He scales patient. He exits mechanical. And that discipline, applied across 40-plus trades per year for 6 years, compounds into generational wealth. You now know the 1/3 formula. You understand the mechanics. You've seen it work across a real case study. You understand the psychology. You understand why amateurs fail and why professionals succeed. But here's the brutal truth that separates the people who watch educational content from the people who actually build wealth. Knowledge isn't execution. Knowledge is potential. Execution is reality. Most traders will finish this video, feel inspired, and then go back to their old habits. They'll see the next setup and revert to emotional pyramiding. They'll add on movement instead of confirmation. They'll hold positions waiting for confirmations that never come. They'll repeat the same mistakes that have destroyed trading accounts for a century. That's not going to be you. Because here's what separates watchers from practitioners, and this is the critical distinction. Practitioners build the rule into their trading plan before they enter a single trade. Not after, not during, before. They don't discover the system in the moment of a trade. They've already decided how they'll execute. Before the market even gives them the signal, before your next setup, and I mean before, not after. Write this down in your trading journal. Make it permanent. Make it non-negotiable. Make it the law of how you operate. First third, entry at pivot breakout on volume. Risk 1% per trade maximum. You identify a structural pivot. You wait for price to break that pivot on volume surge. When it does, that's your signal. You enter your first third. Your stop loss is below the pivot. Your risk per trade is no more than 1% of your total account. If your account is $50,000, you risk $500 maximum. If your account is $300,000, you risk $3,000 maximum. This is professional sizing. This is the foundation. Second third, add only on a higher pivot break or second structural confirmation. Time window 3 to 7 days. If no confirmation arrives, exit the entire position. You don't add because price moved favorably. You don't add because you feel good about the trade. You add only when price breaks another structural level on volume. You give the market 3 to 7 days to provide that confirmation depending on your time frame. If it arrives, you add your second third and your position doubles. If it doesn't arrive, you exit. All of it, not half. All of it. You preserve capital and wait for the next setup. Third third, add only after a third, independent confirmation. If price breaks below entry 1 before this confirmation, exit the whole position immediately. By the time you're considering the third third, you've already had 2 confirmations. You're looking for a third. But if price breaks below your original entry point, your foundational level, before that third confirmation materializes, you don't wait. You don't hope. You exit the entire position. You're out. You've lost. You move on. This isn't theory. This isn't philosophy. This isn't something to debate or refine or adjust based on how you're feeling that day. This is a law, treated like physical law. You can't negotiate with gravity. You can't bargain with mathematics. When you jump off a building, gravity doesn't care about your conviction. It doesn't care about your thesis. It doesn't care that you were right about direction. It pulls you down. The markets are the same. Price action is law. Confirmation is law. Exits are law. Follow them mechanically. Here's the psychological truth that most traders never accept, and accepting it changes everything. The money you make comes from doing nothing between entries. This inverts how most people think about trading. They think money comes from pulling the trigger, from taking action, from being in the market. It doesn't. Money comes from waiting. Money comes from watching the tape. Money comes from not trading when the market hasn't given you permission. Think about Marcus. He waited between entry 1 and entry 2. He waited between entry 2 and entry 3. That waiting, that discipline to not act, was worth hundreds of thousands of dollars. The action of entry was important. The action of exit was important. But the inaction between entries? That was everything. Livermore's final wisdom was this, and it's worth writing on your wall. After great profits, there is always overconfidence. And after overconfidence, there is always a crash. This is the psychological trap that destroys even successful traders. They make money. They feel invincible. They become convinced that they figured out the market. They abandon their rules. They go all in. They over-leverage. And then the market corrects. And everything is lost. The 1/3 formula protects you from that overconfidence because it mechanically stops you from over-leveraging even when you're right. Even when you're up 78% in 3 weeks like Marcus was. Even when everything feels like it's working. The system Eyes wait for the third confirmation, and if it doesn't come, the system says, exit. That mechanical protection is what preserves wealth across decades. Now here's how you start. Start small. Not small in the sense of practice on a demo account. I mean small in real money. Trade one contract, trade one share, trade one position. Whatever your market is, whatever your vehicle is, start with minimal size. Practice the 1/3 discipline on small size where mistakes don't devastate you. Get 10 complete cycles of the formula correct before you even think about scaling up. Most traders scale too fast because they don't trust the math yet. They've intellectually understood it, but they haven't embodied it. They haven't felt it across multiple market cycles. By the time they scale up, they abandon the rules in the heat of emotion. Start small. Build trust in the system. Then scale. Here's your compass. Your litmus test for whether you're ready to progress. If you can't execute the exit rule when confirmation doesn't arrive. If you can't exit the entire position after 5 days of sideways price without a breakout. You are not ready for the second third yet. That's not weakness. That's not failure. That's self-awareness. That's honesty about where you are in your development. Most traders skip this level of analysis. They assume they're ready. They're not. Stay small until the exit rule feels automatic. Here's the final insight that will change how you think about trading. The traders reading this who will make $1 million in the next 5 years aren't the ones who trade every day. They're not the ones grinding screen time. They're not the ones pulling the trigger constantly. They're the ones who trade when the tape says yes and do nothing every other day. That's the edge. That's the difference. That's Livermore's gift. Most traders are addicted to action. The professionals are DI. Disciplined about inaction. They wait. They watch, they measure, and when the signal comes, they act with conviction. Then they wait again. Your next winning trade isn't the big one. It's not the trade where you go all in and make a fortune. Your next winning trade is the disciplined one. It's the one where you enter your first third on a pivot break. It's the one where you wait for confirmation before adding. It's the one where you exit the entire position when the market says no. It's the trade that follows. The 1/3 formula perfectly. Build your pyramids with thirds. Earn your size. Own your process. That's how you build wealth that lasts. The next video in this series will deepen your understanding of how to manage risk across multiple positions, how to scale your account systematically, and how to protect yourself from the overconfidence trap that catches even disciplined traders. But you're not ready for that until this framework is embedded in your bones, until the 1/3 formula feels like breathing, until exits are automatic, until waiting feels natural. Master this, then move forward. The wealth is waiting for those who do.